Right, good evening, everybody. Welcome to this GRA property update with Tony Alexander. It's 2025, June. Mixed messages around the market, so I thought it would be a good time to have sort of a late autumn, early winter update with Tony and talk a bit about what he's seeing in the market, and then give you my feedback from what we're seeing at GRA and through our various channels that we work with. So it should be a good evening, especially with Tony's valuable insight. I'm sure you're all aware Tony is the ex-BNZ chief economist and now is a private consultant and does a lot of consulting to both property and businesses across the country. Just a warning that anything of a tax nature in this is subject to change. So this is June 2025. I'm going to give a bit of a tax update later. And because the tax legislation changes quite rapidly in this country, you should take qualified professional advice in relation to individual circumstances. Not everything I say in this presentation will, of course, apply to you. And we also warn you that because the tax laws change, these might be current in June 2025, but later in the year or next year, if you're watching this presentation, the laws could change. So just be aware you need to check the applicability of the tax I'm discussing in future periods. For those of you that don't know me, I'm a chartered accountant in public practice. At GRA, I'm a property and tax advisor. I've been an active property investor for 20 plus years. I'm doing some quite varied things at the moment. I'm going to tell you about some China construction that I'm doing later in the presentation and show you some of the stuff that I'm doing in this market. Tough market, Tony. And I'm a glutton for punishment. We've been building right through the recession. And, I'm an accidental investor on a couple of high-end builds I've done. Couldn't get the price I wanted, so parked them up as rentals, and I'm confident that next year I'm going to get the price I want. So what the market is feeding back to you and I that we were discussing earlier, it's entirely consistent with my own investing. These days, previously a lot of people have come and sat with me and got advice one-to-one. These days I sit on GRA's board and I mainly run my investments, and you'll see I'm a reasonably substantial investor these days. I'm involved in 30 builds in Auckland at the moment, 460 sections I'm doing in the South Island. I've got a decent sized portfolio with Celeste Chand, one of the partners here. We're about to build 50 houses out of China on the back of our big backyards that we've got in Rotorua. And these are things that were planned in the up market, still work in the down market. The best plans take time to hatch, and later in the evening I'll tell you about those. But before I get into the detail of what I'm up to, we're going to have Tony Alexander, the legend himself. Then we're going to have a short tax update, one slide. There's not much changing in the tax space at the moment, but I'm going to show you the favourite tax structure that we're using at the moment. And then I'll close with just showing you some of the investing that I'm doing. So, market update. I just want to start with this slide. I mean, the news is old, but I'm still celebrating. Worst Reserve Bank governor ever, Adrian Orr. I didn't like this man. He absolutely pumped the market, holding hands with Labour, and he overpumped it, and with cheap money, loose money. And then when there was too much inflation, and particularly house price inflation, he took no responsibility for it whatsoever, pushed interest rates far too high, pulling the carpet out underneath all of the poor investors that got in on high LVRs with anticipating low interest rates forever. And, this guy did that. He's gone, thank goodness. And I understand there was no love lost between the ministers and this man, and he left with a cloud over his head. And he has not done good things for New Zealand. So he's gone. Fantastic, great news for us as investors. He held interest rates too high for too long and put them too low for too long. What you need is moderation in the Reserve Bank. Don't push the rates too low. Don't push them too high. Moderation. And he was extreme in what he did, and it didn't help New Zealand. So I think that is great news for New Zealand. I've got a whole bunch of stuff to say on the economy and particularly the property economy. But before I give you my opinion, we'll bring in the legend himself, Tony Alexander. Tony, good evening.
Yeah, hi, Matthew. And Shall I just go right into it now?
Yeah, all you.
Righty, yep, let's get stuck in. Well, hello everybody. Thanks very much for being online tonight. My disclaimer is sometimes we economists get our forecast wrong. Sometimes, embarrassingly, they can be wrong within 24 hours in this day and age of uncertain times and never know what we're going to hear overnight. But what I'm going to talk about tonight is just first of all an overall look at the economy. I won't spend a lot of time there, given our housing focused, but I think it's important people are aware that something I was warning about from August last year is pretty much in play now throughout the economy. There's a dose of reality running through most businesses out there. And then I'll focus in on the housing market, my understanding of where we are at the moment, based a lot on what I'm seeing from the likes of my real estate agent survey, for instance, and a bit of a view on where I think things are likely to go. And like I say, just to focus on some of the fundamentals in play, and maybe especially a focus on why we're seeing the absence of price rises at the moment. The buyers aren't feeling any FOMO. Some of the specific factors I think that are in play that they can see in play as well, just making people feel that they've got time on their hands for making their decision. So let's just start with the economy overall. We had a deeper than expected recession last year with the economy shrinking 2.2% over a 6-month period. And yes, that was the deep result of Adrian Orr's sort of bad policies there, in combination with a few other things from early last year, like property rates going through the roof, insurance costs increasing strongly, a loss of job security by a lot of people as well, the IRD chasing up money, so lots of cash flow pressures out there. Everything went down. In July, the Reserve Bank signalled, oops, and that they would be easing policy soon. And then people started to get ballistic. We saw the ANZ's monthly business outlook survey, the net proportion of businesses saying they expect the economy to be better in a year's time went from 6% in June of last year to a net 66% come October. In my own monthly spending plan survey of consumers in the middle of the year, a net 42% of consumers like yourselves were saying, I'm cutting back on buying stuff in the next 3 to 6 months. At the end of the year, that was a nice plus 10%, and lots of other indicators like that increasing strongly. But I warned very forcefully from the middle of August that just because interest rates were falling and now so far down by 2.25%, doesn't mean the economy is going to boom. And that was the view I think too many people were having. And what we see happening now is a pullback in these sentiment measures. I now have a net 10% of people expecting to cut back on their spending, consumers, in the next 3 to 6 months, and only a net 37% of businesses expecting the economy to improve in the next 12 months. So key point to note there, net 37% positive business sector still validates a view of recovery in the economy. And despite the little list I'm about to run through here of some of the restraining factors on the economy, we are in a recovery mode. We've already grown by 0.7% during the December quarter, and the common pick for the next growth numbers coming out fairly shortly is maybe another 0.7% in the March quarter. I don't think we're going to continue at that pace of almost 3% per annum. I think it's going to slow down fairly soon. But there is a recovery underway, and it's assisted a lot, obviously, by the interest rates going down, but also the 17.2% increase in export prices in the March quarter compared with a year earlier. Basically, that's, well, a positive surprise. None of us expected it, and it's just something nice that can come along every now and then for New Zealand, and it is giving greater strength to the regions, certainly, than I expected. And then this sort of thing flows through eventually to the cities as well. Export education sector is growing. We've seen some growth in the tourism industry. And importantly, businesses are saying they're going to undertake some extra investment. A lot of experimentation with AI, investment in digitization, and the usual capital equipment, plant machinery, that sort of thing going on. So there is a recovery in place. But one of the key dynamics out there at the moment is that margins are still phenomenally tight. And there's some numbers I've been running through for quite some time now, usually to explain why I don't think interest rates will fall much further, if at all. And I would not have voted for another cut, a couple of weeks there from the Reserve Bank. And it goes like this. If we start with the New Zealand Institute of Economic Research, NZIER, quarterly survey of business opinion, they've been running it since the 1960s. If we start with the data from 1992, when inflation in New Zealand settled to 2.5%, On average, every 3 months since 1992, a net 21% of businesses in their NZI survey have said, I'm putting my prices up in the next 3 months. So 21%, that's consistent with 1 to 3% inflation. The most recent result is only a net 2% positive. So that there, average 21, latest only 2% put their prices up, net, that's justification for easing monetary policy, no worries. How does monetary policy work? It works by removing the ability of businesses to put up their prices even if their costs are going up. And that's where there's a problem. On average, a net 29% of businesses since 1992 have said, I expect my costs to continue rising in the next 3 months. The most recent result, 42%. So you see the pricing well below usual. Costs going to increase more than usual. So there's a massive cost squeeze which is underway in the economy at the moment. Cash flows by businesses are highly constrained. And this is made worse, of course, by the likes of the IRD, chasing the overdue debts there, PAYE, GST, the low interest loans, etc. So margins are very tight. And one measure I create suggests maybe they're even the tightest since about 1972, just by this particular gauge there. So that is one reason why businesses are looking around themselves and have been doing this now for sort of 3-4 months going, well, I've survived to 25. Is this it? Then there's a few other things just to put in there as well. Fiscal policy is tight by the government, so we no longer have 6 years of overspending by a Labor government. We've got a national government back in, trying to put the books back in order, which is what they have had to do every time they've replaced Labor over the past 3 decades. Ruth Richardson in 1990, Bill English from 2008, and Nicola Willis from last year and from this year. Next year, well, that's an election year budget, so she needs to leave something there at least for something to be given away. So that's a source of a little bit of restraint on the economy, not much. It's more the absence of the extra spending we were getting for a number of years there. A few other things. The Kiwi dollar, normally when we come out of recession in New Zealand, it comes from the regions, and the initial trigger is a 10 to 15 cent fall in the Kiwi dollar because interest rates plummet. This time around, the Kiwi dollar never went through the roof when the Reserve Bank was tightening because rates were rising overseas. And this time we've only fallen 2 cents from a year ago, 4 cents from 2 years ago. It's neither here nor there. It's positive, but it's not the traditional surge in the regions for the exporters that drives our economy to a 6% growth rate as we saw after the recessions of 91 and 97, 90, 98. This is more a gradual upturn, I'd suggest, like after the global financial crisis. One of the other things out there, I won't run through my full list there, but one other important one to note of relevance to the housing market now is net migration. So in the year to October 2023, we had a net migration gain of 135,000 people, untold extra people. Now we're down to a net gain in the past year of just 26,000 people. If we look through that weird 2023 boom, post-pandemic situation, the average annual net gain for the past 10 years has been about 50,000 per annum. So we're running at about half that at 26,000 in the past year. And this is sort of encapsulate a lot of my restraining list factors there. It's still positive. It's just not as positive as we've got used to in the post-pandemic period there. But it helps explain, as I now move into more the housing situation there, it helps explain one of the stronger results in the monthly survey I do of property investors. I've been doing this since about April 2021. And one of the questions I ask the investors there is, are you finding it easy or difficult to get a good tenant? Now, 13 months ago, so just over a year ago, I had a really high net 25% of investors saying it is easy to get a good tenant. Well, now I've got a record net 33% of investors, landlords, saying it is hard to get a good tenant. There's a lot of property out there for the renters to choose from. And it manifests itself also in the net percentage of the investors saying, I'm putting my rents up over the next year. If we go back to late 2023, I had a net 84% of investors, landlords saying, I'm putting my rents up the next 12 months. I mean, it sounds normal. Well, now that's down to only about a net 47% of them saying they're going to put their rents up. So there is that manifestation of this looseness in the rental market, lots of properties out there, not as many tenants, and manifesting itself as some slower rental growth out there. But that's just one of the indicators out there in the housing market, which paints a picture of, for the second time since the housing market started to pick up early 2023, driven by first home buyers, for the second time, the upturn has fizzled out essentially. And we can track that if we look at, say, the FOMO reading, so fear of missing out, the proportion of real estate agents who each month say that they can see buyers a bit worried and that they're feeling FOMO. Early 2023, only 4%, like no buyers gave a damn, quite frankly. In October 2023, there was momentum. Some investors were getting into the market the middle of 2023 as well. FOMO got to 40% of agents seeing, oh, buyers wanted to be in a bit of a hurry out there. And then everything went bad in the economy over 2024. It all came together, like I say, in that deeper than expected recession. Middle of last year, 1% of agents seeing FOMO. It just completely disappeared, essentially. And then we see the upturn occurring, the optimism with the interest rates expected to fall from July, actually falling, the cash rate going down from August. People are getting happy. Buyers are coming back into the market again. But this time around, FOMO at its peak only got to 19% of agents seeing it in October last year. It's now just 5%. So the FOMO is back to where it was just over 2 years ago, before we saw the wave of first home buyers coming into the market early 23, attracted by the prices being lower, strong listings, and the lack of competition from other buyers out there. So yeah, the market developed some upward momentum again with all the happiness and the joy about interest rates going down, but it hasn't been able to sustain itself. I don't think we're in a fresh downturn. It's more that couldn't quite get it going, and now we're going to pop along at flat levels, I think, for a while, until maybe a lot of this excess stock out there is frankly used up. So if I run through a wee bit of a list here of, some of the things that I think account for why we've got this new stalling in the housing market, just for now. One, of course, I've sort of said a number of times, there's lots of stock. The number of properties listed for sale at the moment, about 33,000 with realestate.co.nz. In the middle of 2021, that was about 13,600. There was hardly anything available. Now there's a good number of properties available. It's roughly the highest since 2015. So there is a lot for people to choose from. And hence we get this low balling of offers being put out there. The vendors haven't yet quite caught up with this situation, and it is solidly a buyer's market. In my real estate agent survey, I think I've got about a net 34% of the agents saying the buyers have the upper hand, the vendors are most motivated to get the deal done. In other words, it's a solid buyer's market all around New Zealand at the moment. Now, one of the interesting things, of course, is construction. We've seen a lot of houses being built over the past few years. The pandemic boom, excessively loose monetary conditions, the stock of housing disappearing, everybody becoming a developer, building, etc. Things went through the roof. And then what we saw was 9 quarters in a row of house construction falling, actually until the March quarter of this year, when it bumped up. I think it was about 2% or so, bit of an actual move up in the construction there. Nothing too much to worry about. If I look at this in terms of the number of consents issued for new dwellings to be built, 3 years ago, it hit a record high forever in New Zealand of 51,000. So, yep, that was pretty big, about almost 1% of the population back then. Now we're down to about 33,000 or so consents issued in the past year. And we've been at that 33 to 34,000 for almost a year now. The stability has set in with the consents. And I don't have screen sharing here, but there's a graph I'm going to put in my weekly commentary, not this Thursday, but next Thursday. It shows a comparison of the number of consents issued versus dwelling sales out there. And consents, when you couldn't find anything to buy, the sales were constrained in the market, consents went through the roof, they've gone down, and now they're back at about their new average. In other words, I look at the consent numbers out there, still trucking along 33, 34,000. I talk about the housing market upturn stalling for a second time. Does that mean I actually think the number of consents is about to fall away again strongly? I don't think so for standalone houses, but I do have an issue with the townhouses, where clearly there is an oversupply in some parts of the country. Auckland predominantly, but Christchurch has also got some oversupply down there as well. But the key thing to note there is that the consent numbers are still relatively high after the pain of the high interest rates, after the double recession that we have had. And in fact, what I did a few weeks ago was a comparison using data going back to 1970, where for each year you can work out the number of consents issued. Like in 1973, it was 40,000. That was a boom. Versus the population. 1973, that was less than 3 million. So you work that out. It's about what, 1.4% or so for 1973. On average, in the past half a century, the ratio of consents to the size of the population, 0.6%. What's the ratio now after all the pain of the tight monetary policy, etc.? 0.6%. That's 34,000 or so consents versus 5.3 million people in the country. So a key dynamic out there is that over the past few years, we've seen a structural change in the average level of residential construction in New Zealand, or at least the number of units, because there's more smaller stuff being built out there. And I think this simply reflects the combined impacts of what we learned from Jerry Brownlee freeing up that land in Christchurch, rezoned residential after the earthquake, make the land available. Section prices are constrained, at least for a while, around Christchurch. And of course, the unitary plan in Auckland in 2016, make densification, intensification possible. You get extra stuff being built out there. And of course, with this being rolled around the country, councils having to see where the 30 years worth of development land is going to come from. Intensification still being debated, pushed back, but happening more and more around the country. There's been a structural shift in the level of house construction in New Zealand. And so that is one of the factors which means, hey, for the next 30 years, the average increase in house prices, it's going to be less than what we've seen in the previous 30 or so, which was about 6.3% per annum. House prices at the moment, they're about 7.2% times what they were about 1992. So that works out about 6.3% a year. Going forward, maybe 5% or something like that. And it'll vary from region to region. But there's more construction. And it's like, this seems to be a positive thing. There doesn't necessarily mean, oh, more construction, therefore house prices keep going down. Because, of course, construction costs keep going up, quite frankly. In New Zealand, and the same in Australia, over about a 4-year period, up until about a year ago, these construction costs increased about 40%. So it's not a specific New Zealand thing when we talk about this 37 or 42%, whatever. Same thing happened across in Australia as well. History shows that when the construction costs go up, they don't often go negative. It's pretty hard to actually get the costs going down. Strengthening health and safety requirements. New wind has to get from one side of a townhouse to the other in Auckland situation because of the heating issues, all these sort of things out there. So it's like there's a floor that's provided for the house prices by the construction costs and what's happening there. I mentioned really quickly about 15 minutes ago, one of the factors behind the weakness in the economy that surprised us all towards the middle of last year, job insecurity, job uncertainty. Again, in my survey with real estate agents, been running over 5 years now, one of the questions I ask the agents is, what are buyers worried about? And so they can tick the box for there's not enough listings. They can't get the finance. The interest rate's too high. They're worried prices will fall after they've bought. And they can tick the box if they choose of people are worried about their jobs. The average tick there is about 21% of agents would say people are worried about their jobs. At the start of 2024, it was only 14%, 14%. So we started last year with people feeling pretty happy about their jobs. Middle of last year, 56% of agents saying people are worried about their employment. My most recent survey, a week and a half or so ago, still 51%. So one of the dynamics in the market at the moment is a feeling by many people of job insecurity. And that probably helps account, it may not help may not necessarily mean a lot to maybe the young buyers who are still the dominant force in the market, but the owner occupier is looking to change. Okay, am I willing to sell what I've got, buy another one, but I'm a little bit uncertain about my job? I think it's having an impact there in the middle of the market, and less so maybe for the young buyers who see that the market is massively in their favor. And the data we get from Cotality, ex CoreLogic, tells us still for about 2 years now, 27% or so of house sales in New Zealand, dwelling sales, go to the young buyers, the first home buyers out there. But job insecurity is still high out there in the economy at the moment. Listening to the news early on, it's all about the 98 people losing their job at Smith & Coe's and Queen Street up in Auckland there. And businesses, remember what I said earlier, the margins are tight. They're under pressure. The cash flows aren't what they thought they were going to be. They need to find savings. Some with some capital are looking at boosting productivity, new machinery, or whatever. But I think for a lot of them, there is still weeding out of some of their staff numbers, etc., to do, changes in processes to be undertaken, rationalisation of number of outlets around the country or whatever. And clearly in retailing and hospitality, the crunch is still on, frankly, out there. That's going to continue all through the rest of this year as people go to your cafe and everything's so expensive. And I discovered a trick also. When you go and order the vegetable slice or something from in the cabinet, it may not quite be that size when you get it on their plate. I think there's a trick where they put two slices together in the cabinet and you think, oh, wacko, that looks like a decent bit of lasagna or whatever there. No, it's going to be half that when it hits your plate. So shrinkflation or whatever out there, and it leaves a bit of a sour taste. Anyway, there's still redundancies, losses in the hospitality retailing sector. I also think when it comes to construction, I can't help but think surely there's still some weeding out left a bit out there, especially in the multi-unit development side. I could be wrong. And the reason I say I could be wrong is we have decades of data on the cycle for standalone houses, up and down, we have a feeling for it. Not for townhouses. The numbers really started rising about 10 or so years ago. So we've got a big up and we've got a down, and that's it. So we don't know what is normal when it comes to townhouses out there. I've already mentioned the rental oversupply out there. So we've got developers, as Matt himself was saying there, can't sell properties for the prices that they are wanting out there. And so they put them in the rental pool market for a while, or some I've heard just maybe put half in the rental market and still keep trying to sell the rest out there. I've also got this final thing I'll just mention here. There's a lot of information out there on investors buying. And be in no doubt, there are many people looking to invest in the residential property market. I gave a talk to 150 of them in Tauranga just last week, for instance. So yes, there is investor demand out there. They see the good availability of stock that the young buyers see, the good choice. They see, some bargaining ability, etc. What's not seen, but what I can see from 2, possibly 3 of my surveys, is that there are also investors who are selling. I can see that from the existing property investors. The one I do with Crocker's there. What have I got? The net proportion of the investors saying I'm looking to sell. The average is 27%. The latest reading is a net 34%. So it's not huge. Okay, it's not a huge number, but it's greater than average out there. And I get other information on this when I look, like I say, at my real estate agent survey there, the proportion of investors are looking to sell. And so there's that extra supply coming forward on the market. And maybe it's from the older investors who are looking to finance a retirement. Either they're in retirement or they're going to be in retirement soon. And the costs of their retirement are turning out to be a hell of a lot more than they expected. They didn't budget for this level of council rates. They didn't budget for last year's 26% average increase in insurance premiums. They didn't budget for the electricity price increases. They didn't budget for the soaring prices of the dairy products at the supermarket and the meat, etc. People are having to redo their numbers. And in conjunction with difficulties getting or keeping a good tenant, maybe some healthy homes maintenance issues, etc. coming up, the cost of holding your rental property, again, council rates, insurance, etc., as well as on their home they're looking in. I have a belief that there's a cohort of older investors looking to get their property sold as well. That, of course, presents a lot of opportunities for people out there. There's very strong demand from the investors for existing properties. Yes, for new properties, not the extent it was, 2 or 3 years ago, but there's great opportunities for buying up something older and then renovating it, or, holding it for development purposes, given that the populations are going to continue to grow in New Zealand and the cities around the country there. So there's an opportunities for some of that long-term land banking of some of these properties being put on the market, like I say, from the older cohort of people out there. So when I put it all together there, the bulk of the interest rate stimulus to the economy and to the housing market, let's say 80%, 85% of the stimulus to our economy from easing monetary policy, I think it's probably already out there, either in terms of people's interest rate actually has gone down, or they expect it's going to go down soon. So it's already factored into their head, their actions about what they buy, what they invest in, etc. And I don't believe the Reserve Bank will be looking to cut interest rates much further, if at all, from where they sit at the moment. And that's the final lot of numbers I'm going to put in here. You see, normally when I talk about those numbers, remember I said NZIR survey, on average 21% net going to put prices up next 3 months, only 2. On average, net 29% say I expect my costs will go up, and now it's 42%. So there's the margin squeeze in there. And I often do that in this area where I'm talking about interest rates, because that only looks ahead 3 months. The ANZ's monthly business outlook survey looks ahead 12 months. And when businesses are asked to look ahead 12 months, on average, since 1992, a net 26% of businesses have said, I'm going to put my prices up in the next 12 months. So that's normal. That's what you'd expect to see with inflation, 2.5%. That proportion was at 82% net about 2-3 years ago, got down to 35 last year. It went up to 51. It's still sitting at a net 45% at the moment. So even with businesses highly constrained out there, they're still a bit worried about the economy. And a net 45% are saying, when the customers return, I'm putting my prices up. And why? Margins are massively crunched at the moment. And a really high net 73% of businesses say, I expect my cost to go up in the next 12 months. And these sort of readings were coming out before Tariff Liberation Day of April 2, and whatever extra inflation comes out from that around the world for stuff coming into machinery. We simply don't know what that's going to be out there. But
Tony,
that is a concern which would have led me to have not increased the interest rate, just to see how things pan out over the remainder of this year and keep some of my powder dry. So don't be thinking there is potentially necessarily any further interest rate stimulus to come to the economy or to the housing market. We're just about there. And especially if we're talking about 2.5 years and beyond fixed. Maybe floating out to 2.5 years, you could get a little bit more coming down, 2 years if you're lucky, sort of thing. But frankly, this is almost as good as it gets on the interest rate side. So, Matt, I'm going to knock it on the head there. Like I say, my outlook for the economy, recovery is underway. It's just not going to be a boom. That's all. Housing market recovery was underway. Oh, then it stalled. Then recovery got underway again, and now it's sort of stalled again. But the underlying pressure will see the prices again rising in the future. And my final comment will be, when you think about people's thoughts about the housing market over the past 1, 2, maybe even out to 3 decades, and the sort of market they wanted as a buyer, as an investor, or as a young buyer, well, this is sort of it. High listings, not much competition out there. The banks slowly becoming more willing to lend the money out as well. This is a great opportunity to be making a purchase. It's just that for the moment, people think, time's on my side. I'll wait and see what happens, which means it'll get interesting at some point next year when everyone's going to go, oh, I think the market's moving, I'd better get in. And I think that's a story for some point in 2026, but not so much this year. Matt, knocking it on the head there.
Thanks, Tony. Great. Interesting you said that there's a net 45% of people expecting to put their prices up. Do you think that they're just not reading the papers? I mean, the economy is contracting all the times. All the time I'm dealing with the community, and some clown comes in and puts in a 2021 price, and I say, forget it. And they're just trying it on.
Yeah.
And a lot of people are not reading the writing on the wall. I just think there's still a bunch of people out there that think they can mercilessly keep putting the prices up. Some quite high profile building company that's come to mind, and they're just going to not sell anything. I've got a surveyor that's pissing me off at the moment, if you excuse my French, who has just put the price up and up and up, and he's just pricing himself out of the market. So many people are looking for the work, but guys are still trying to put their price up because they've been doing it for the last 2 or 3 years. They're not reading the writing on the wall. Do you think there's a bit of that in there? The recession's looking worse than they realise that it's going to get worse? My feeling is it's much worse than a lot of people realise. We're seeing a lot of pain in our client base.
My view is that a lot of costs are still going up out there in the business community. They don't necessarily come through capital goods price index. I think it seems it's an anticipation of extra increases. Like I say, that's why I emphasize the NZIR's survey only goes out 3 months, and it shows what's happening basically right now when there's the crunch that you're talking about out there. But yeah, there's an expectation of, well, if interest rates are down, the economy is going to improve, and net 37% of businesses believe there's improvement underway. And I agree, especially with the high red meat prices, the dairy prices, this is the sort of thing that feeds through the economy. And a net 73% of businesses say, well, my costs are going to keep going up for the next 12 months. And that's why I'm saying, as soon as the economy has sufficient strength and as soon as they think they can seriously get away with it, then they're going to put their prices up. And it's concerning that you're saying some of them are going, yeah, I'm going to take the piss and have a go and putting the prices up now. Yeah. And some will get away, some won't. And New Zealand, unfortunately, has a lot of oligopolies, a lot of sectors where there's only 3 or 4 or 5, sellers. And so we keep getting this sort of structure applying upward pressure to inflation. And you look at local authorities, the monopolies. All you can do if you don't like the rates increase from one local authority, go to another one, which is a new monopoly that you're going to have to put up with out there. So it is still problematic, I think, and that's why I think the Reserve Bank is going to be cautious, and why most of us think they're pretty much at a neutral setting now for their outlook for policy.
Yep. I reckon there'll be more pushback than these organisations think, especially the ones where it's discretionary and not an oligopoly, as you say. So I've got a few questions here, and then we'll open it to the floor. The first one is on interest rates bottoming out. I myself had this target number of 4% as my next fix for 5, and it's in my slides tonight.
You're dreaming.
and that is based on my thoughts that the economy is in much worse shape than people give it credit for. And as that keeps emerging, I just think there'll be more downside pressure on interest rates to create stimulus. And I guess the counterpoint is if the Reserve Bank is seeing inflationary pressure, they will quell that with keeping the OCR up. But it's politically very unpopular, and I know the RB is independent of central government, but a recession's a recession. They actually need to recover, or the economy will stay. If the interest rates are keeping the foot on the recovery, they need to release them.
Yeah, you sort of answered your own question and concern there with reference to Adrian Orr. He eased too much. He tightened too much. So what's going to be right at the front of the Reserve Bank now? Let's not ease too much, or we end up having to have to tighten too much. And so they are strongly incentivized not to assume the worst scenario for the moment. They are incentivized to focus, in fact, on growth signals in the economy, the expected feed through from the good prices in the dairy sector, the red meat sector, horticulture, for instance, some improvement in, like my most recent consumer confidence reading was actually less negative than the month before. They'll focus on that. I certainly don't think that there's a strong recovery underway. And even though we might get another 0.7, you annualize 2.8, no, I think it's actually going to slow down from the June quarter onwards. Because even if you look at the dairy farmers, maybe $10 per kilogram milk solids 2 seasons in a row, and you think, oh my God, imagine how much they're going to be spending out there, until you realize the break even is about $8.50 or so. And the sheep and beef sector, great red meat returns, but it's shrinking. It's getting smaller out there. So there is constraint. So I think the interest rates are going to be sort of settled now for quite a long period of time, I guess is what I'm looking at. And I wouldn't expect 4%. Couldn't rule it out, but for me that'd be the 5 to 10% chance scenario.
Right. Okay. Well, you're a bundle of fun, aren't you?
Yeah, sorry about that. That's why I have to emphasize but there's still a recovery underway. Don't forget
Yeah.
that.
Yep. So there's an interesting comment here from Navit. He says to me, you believe that the New Zealand property market would peak in the years ending 7. So traditionally we had 87, 97, 2007,
Yeah.
2017. Do I still think it's 2027? And my answer to that is, well, we got a double boom because we had Adrian Orr and Grant Robertson holding hands. And we got a double boom in 2021, and that breaks the cycle. So will we see 2031 as the next 10-year cycle? We did get a 24% decrease in average house prices from boom to bust post 21 to where we are now. What's your view of all of that? Do you have a view on next cycle peak? Has the cycle broken?
Yeah, it's like yeah, everything's been thrown up in the air, I think, by the global pandemic, and now with President Trump in there as well, bringing obviously world trade uncertainty, and then we've got AI and whatever disturbance that makes in terms of business investment patterns going forward, etc. Perceived limits on how much further they can keep borrowing money in some countries like the United States and spending it, which brings interest rate risk, of course, there, just like for some states in Australia. But for me, I think a lot of it really comes down to I think there is a structural change in the average number of houses being built in New Zealand going forward. And that's why I was talking about the average was consent numbers 0.6% of population for the past 55 years. And now we're still at 0.6% after the pain of the interest rates. And so that says to me that we're not going to get the same supply. Oh, the houses aren't around, pushing prices up strongly, and then everybody's getting concerned and ballistic and FOMO is through the roof in 2027, and then you get your cycle either 27, 2028. I'm not so certain that's coming around. There are a great number of people who've gained some familiarity with property development now. The pressure is on the councils to make the land available, work with the developers to make the supply available. And so I guess I'm seeing more of a capping influence there, which seems to me like a pretty positive thing, quite frankly. So I would, I'd have to
Not
see
everybody
it.
wants to live in a terrace townhouse. A lot of people want a freestanding house.
Yep.
And and a lot of the sales for those freestanding houses and the top end of housing drags the average up because they're much higher price points, 5, 6, 7 times the price of the terraces in Auckland, aren't they?
Yeah.
So I think it'll become more niche where you might see higher growth in the middle to top end because there's a shortage of development in that area because everybody's piling into the low end. So it might become a bit more nichey.
It could easily. It depends on I guess, the bulk large subdivisions being made available. Outskirts of Christchurch, Highfields, the infill from Belfast, Marshlands, etc. That
Very,
sort of
very
stuff.
area contingent, isn't it, as well?
Yeah.
Because, so it's becoming a bit harder to pick. So you asks any comments about updated CVs recently.
For Auckland?
Yeah, they're down 9%. I saw as the average 8 or 9%. And
the news is old and irrelevant. Quite frankly, as the council have so stressed to their credit, this is only relevant for rating purposes. And it's a market estimate of the price in May of last year. So if I was looking for a guide for a property I might have at the moment, I'll be looking more at REI and Z house price index for my locality, or whatever CoreLogic Cotality might put out, for instance. Yeah, no, I don't really think there's any great implication for this at all, despite every man and his dog going online. Hey, I did for my Auckland apartment earlier on today. Luckily, it's about the same as it was in the earlier period, which unluckily means I get more than a 5.8% rates increase.
Yeah, that's right. So if you go down more, you get a bigger increase in rates, is my understanding. So that's not ideal. Somebody says, Jean says that they just refixed for 18 months at 4.89. I think that's a great rate. At the moment, we're seeing fixed for 5 at around 5%. We're seeing those on the for investors, larger investors. I'm still hoping for Tony. I might bet you a bottle of beer that I get closer to that.
I think if most people at the moment, I've just got the results from my latest mortgage brokers survey back, and most people are going 1 to 2 years. Some are definitely moved out to the 3 year, but still not many. We Kiwis, we tend to go for the shorter terms. Only a few people went for the 5 years when exactly 2 weeks ago, 5 years. 2 weeks ago is when we saw the 5 year fixed at 299 a pair, and I jumped up and down like an idiot for 11 months while it was still there. Well, for those poor people, oh, they're rolling from 2.99 to 4.99 or something at the moment. So just take into account some people are actually going to be making more, paying more on the rolling fix. If I were borrowing at the moment, for me, I'd probably fix the 3 years at the 485, put that to the side then, and just get on with all the other aspects of my life. And 5 years at about 5% seems pretty good to me.
Yeah, I'll wait for 4. I'm fixing 6 to 12 at the moment. Simon Todd says that realestate.co.nz has 41,600 houses for sale at the moment, so even higher than you thought.
Yeah, it must be a different data set. Maybe that includes sections or something. Got to look at your classification on that one. So it's about 32,700 was the stock at the seasonally adjusted at the end of May.
Yep, and Jonathan Waite says, do you have any numbers on high earners leaving New Zealand, taking equity with them and leaving an equity vacuum in the housing sector?
Oh, no. New Zealand is pathetic when it comes to sort of data on a lot of things out there, and we certainly don't have that information. Frankly, maybe not in a lot of countries do actually. What I have noticed, however, is just as I've said, I think there are some older investors looking to sell. They're just realizing the value of their investment to finance retirement. It's become a bit of a hassle, and the costs have gone up, etc. I think there's increasing number, a gross outflow of older Kiwis. So not retired Kiwis, but the parents of the kids that are leaving. And just my neighbour across there, Lifestyle Blocks north of Wellington, not a strong market at the moment. There's 2 up the road that haven't sold. They sat on the market for a year. One of them's trying to get the 2021 price. No hope. The other one's trying to recoup $250,000 of renovations spent on it. Well, they're not going to get that. My neighbours, well, their 2 boys moved across to the Gold Coast for work over there. They just put their property on the market by tender, met the market. They were gone in 4 weeks. And so that generation, the parents of the kids, I think there's an outflow there. And of course, they're going to be taking their wealth and expertise with them as they look around them and see maybe some threatened job opportunities, certainly around the Wellington region, obviously for obvious reasons. But yeah.
Well, Wellington is very much affected by the political environment, isn't it? So Bob Jones, I read once, he astutely pointed out that Labor spend large and fill all of the commercial buildings with social agencies we don't need.
Yep.
And fill government with people we don't need, and then the National Party come in and disestablish that, pay out all the long leases and the contracts that they've committed to, shrink government, and it's incredibly recessionary. It's very, very painful for the people in Wellington, and their housing market gets hit harder.
Yep.
So yeah. Now, Jean says, what factors are contributing to the rural economy market outperforming major cities like Auckland and Wellington? Additionally, how would private building consents impact on the property market and the speed of construction?
I don't have a view on the private building consent authorities sound like a positive thing. There's other moves they could make. I was listening a few weekends ago to the Peter Wolfman or something. He's got the News Talk ZB Saturday or Sunday morning resident builder thing. He was noting that if you submit your building consent and the council's got an AI, the AI will go through it and get back to you like within an hour or so and say, well, here's 5 extra things that you actually need to supply. This is what you haven't filled out. Whereas the council might take, the 20 days or something to get back with their further questions on it. So innovations like that, I think, can be put to use and make some improvements in the consenting process there. In terms of the regions doing better, yeah, I had a view a year ago in terms of the economy improving over 2025, that it would be a more even sort of thing. The cities and the regions, everybody in it. No, not with the surprising jumps we've seen in the commodity prices out there. It's going to give greater strength in the regions. It's the sort of thing which is a bit more like the traditional upturn, just without the exchange rate collapse assisting thing. But you see it in Invercargill and Dunedin, similar times there, very early. Christchurch, reasonably early with the rural hinterland, but also through your Taranaki, Bay of Plenty, Waikato areas. Auckland will be feeling it next year. Wellington won't feel it till 2027. That's the traditional lag out there. There's also, I think, another factor. I don't think the magnitude is strong, but I do think it's there. Yeah, I look at these big increases in the rates in the cities, the insurance premiums, etc., and I can't help but think for some of the older people, we're going to be seeing a desire to free up some capital, get lower rates, and so shifting themselves out towards the regions. So I think maybe there's a little bit of support coming through from that, but not quite so much. It's really just more the economies boosted by the good returns out there.
Canterbury's the fastest growing area in the country, isn't it, by population?
Well, yeah, very rapid, and they've got the land available, Rolleston, yeah, all that, yeah.
Yeah, Darfield's the place we want to be. I'll talk about that. Jonathan Schmidt says there's so many vacant houses. Why do I always hear there's a housing shortage? And somebody else mentioned that there's 44,000 houses vacant in Auckland at the moment. I just think that's the media, isn't it? There's a surplus of housing, that's for sure.
Yeah, there are always empty houses, sold, not yet occupied, holiday homes, houses that are decrepit. Like you need somewhere between 12 and 15,000 new houses to be built each year just to replace those that have fallen over or are just not able to be occupied or just getting bold. You know, that sort of thing out there. And in terms of no one's much talking about shortages at the moment. I think because the prices have come down, because the listings are strong, and it's impossible to calculate what a shortage is without the person talking about it taking a stab on, this is what I think the occupation rate should be for your city or for your region. And I remember doing a lot of work on this 5 or so years ago, saying, well, the shortage you could calculate for Auckland depends upon which region do you think Auckland should look like. Do you think it should look like maybe Nelson? I think I calculated that meant you need another 80,000 houses to get the same average number of people per house in Auckland as in Nelson. But what if you thought West Coast, South Island is what you wanted to be like? Well, then you needed another 250,000 houses to be built in Auckland. So you can't calculate shortage without taking a view on this is what you should look like. You should have the same number of people per house as Ekarahuna or whatever. So I don't talk about shortages. It just doesn't add up.
Tobias said, Tony, if we quantify the average increase in rental property operating expenses, rates, insurance, R&M, etc., ignoring interest, since 2019, the cumulative change is likely over 50%. Is it reasonable to expect rentals to trade on higher gross yields than otherwise to compensate?
I would think so, yes, but I think there's some weeding out to be done of those properties because there's such a large supply now of rental properties. Airbnb's not being used because the number of visitors is still only 85% of pre-pandemic. Developers putting stock in the market now. That's going to suppress the rental growth. But of course, we never know for how long. Just because there seems to be a bit of an oversupply at current prices in a particular market, you can't take a strong view on when that dynamic shifts the other way. And that's partly why I highlighted 13 months ago a net 25% of people, landlords saying, okay, it's easy to get a good tenant. 13 months later, a record net 33%. It's hard to get a good tenant. These things can actually turn quickly on you, which means probably somewhere down the track, before 27, it's going to turn quickly the other way and tighten up in the rental market. Sometimes I talk about that if I'm trying to get through to young people saying, watch out, there's a trap at the moment. The trap is to look at the ease of getting a good rental and go, the best thing I can do is keep renting. No. The best thing you could do is get yourself into a property where there's a great choice, because if you leave it to when others are looking to move out of renting, the house prices will already be rising, and then you're going to get some fibro boarded meth house sort of situation, because then there'll be some sort of shortage down the track there, which admittedly I don't see as being imminent. But I just think for young people, the incentive is not to stretch out renting just because it's easy at the moment. Take advantage of the market, buyer's market.
Well, on that topic, cost of renting is rapidly approaching cost of owning, and that's normally when I see the the younger investors come to the market, and we're seeing those now too. So I think there are some positives, and I wish I could get my camera to stay there.
I've just got to plug my computer in. I just forgot to put the power cable in, so I'm wondering, are you jumping around because
somebody call us boomers, Tony. We were having our IT problems earlier. Tony, do you see tariff dumping of Chinese goods in New Zealand being deflationary? Could rates fall more if that scenario comes through?
Yeah.
Tobias,
I'll see if I can remember this around the right way. I think in the budget, Treasury assumed the tariff war would have a slight increase impact on New Zealand inflation. I think, and the Reserve Bank assumed the opposite, going downward. So it was either Treasury up, Reserve Bank down, or the other way around. Whatever, the two biggest sort of official forecasting groups in New Zealand had a divergent view on what the impact is going to be. Nobody knows. You're looking at data coming out of the United States, and so far the inflationary measures don't look too bad. The labour market impact so far doesn't look too bad. People are waiting for the economic collapse, and it hasn't come along. This is unprecedented. So we just as at the start of the pandemic, eventually it took
Taco,
me.
right?
It
Taco.
took Taco.
Trump always chickens out. Taco.
Trump always chickens out. Yeah. Well, as it took me 2 weeks to figure out at the start of the pandemic. Oh, that's right. None of us has experience of what normally happens during a pandemic. How can we know? None of us has experience of what normally happens when you get the largest country on the planet, biggest economy, initiating a trade war, especially with the second largest economy on the planet. So we don't know how this is going to play out. So the most central banks around the world will be just taking that as it comes along and not assuming either a big inflationary impact in their economy or a deflationary impact because maybe the Chinese dump some goods. We don't know. I do have a theory that surely we've got to get a whole lot of cheap pink fluffy unicorn stuffed toys down to New Zealand in containers out the back of the warehouse
Maybe
situation.
a few cheap Teslas too.
Surely it's got to happen. So yeah. I don't think we face too much
Chinese are
inflation.
very good at making cheap cars, and they've got control of the lithium market. They're making better batteries for that. So I would say cars are going to get cheaper. That could be deflationary. When do you see FOMO kicking back in?
Yeah, you can't forecast it. Can't forecast FOMO, but yeah, generally, when do I think people start to get a bit antsy about the whole thing? It's not this year. Maybe next year, the listings are going to have to start coming down. To take a strong view on that, I'd need to have a strong view on what will the level of townhouse construction be. And honestly, I'm confused about the outlook for townhouse construction because I would have thought surely with the oversupply, the consents would be coming down. No, they've stabilized and with a little bit of an increase out there at the moment. So I don't think the FOMO is going to be sort of a driving force in the market for some time. And I guess what I'm saying, it could just be normal buying, normal selling in the market without any feelings of we've got to make this a hurry to either sell into the market or buy into the market. And that sounds like a positive thing, I suppose.
I reckon NDRS and with medium density residential standards and unitary plan, I think that's changed the game.
Yeah.
And we should be expecting lower rates of growth. Somebody says, what's your opinion on long-term house price increases? 3 to 4% will be more boom bust or flatter?
Yeah, I think just a bit more than that.
Right?
Yeah, if we assume 2.5% inflation going forward, allow for wages growth and extra growth in the construction, that's why I've gone from average house price increase nationwide since 1992 of about 6.3%. To me, 5% or so sounds reasonable.
Yeah.
Ask me in 30 years.
And as we discussed this afternoon, I would see house price inflation being more correlated to construction inflation.
Yeah.
There's no shortage. So it's just purely what does it cost to replace the house?
Yep.
And that'll be correlated to construction inflation. Probably wrap it there. These guys are hammering us with questions, but that's probably enough. And once again, very generous with your time, Tony. Thank you very much for joining us. And as always, very enlightening. And look forward to see you on the next one. Appreciate it.
Yeah, look, thanks so much for having us, Matt. Thanks, everybody. Ta-da.
Thanks for coming. Good night. Right, so that was great. Let's get into the next section. So it was interesting. Tony's on record recently saying last 10 years, last 30 years have got an average of 7% growth. And he's just told us that he sees it reverting to 5%. And I share that. So the heydays of property, I don't think that they're there, certainly not in the next decade. There's just such an overhang of surplus housing stock. I kind of wanted to run these slides through with Tony actually, but didn't get a chance to. So my view of what I'm seeing, talking to clients and talking to colleagues in the property market, rates are dropping, not as fast or as far as we hoped for. I'm seeking to refix at 4%. A lot of people talk about the stuff I've got skin in the game. I've got close to 24, 25 million of debt in my buy to hold portfolio. So the stuff matters to me, and I traditionally get the stuff right over the property cycles. And I had all of that debt, nearly all of it, fixed at 2.9 for 5 and 7 years. So I picked the bottom. We got to the bottom. Everybody said, "Oh, you know that we might have negative interest rates." I said, "Well, that's bullshit. That's not going to happen in New Zealand. You don't have to refix right at the very bottom." And I'd say that again here. If I see the market conditions turning and inflation returning, then I will take the 5-year rates quite quickly. But my feeling is we're going to see 4. So I'm willing to bet Tony a bottle of beer that's a 5-year rate. I only take 5-year rates. But at the moment, I'm fixing short 6 to 12 months because I think we'll see it bottom out next year. Next year, we can have election uncertainty on top of the recession. It's not going to be good. I think next year we'll see, if we're going to see the OCR dropping, it'll be first quarter next year. We're seeing DTIs start to impact some borrowers. There's a lot of surplus listings. There's falling of rental demand. A lot of the things that Tony has just said to you, I'm echoing in what we're seeing in the client base. But the reverse side of this is there's a great time to buy. You can get some really good deals out there. And you don't even have to be in a hurry because there's so much. We're spoiled with options. Next year we have an election. Just remember, this coalition government are fixing a lot of problems. Yet they're polling very poorly. Labour, Greens, Maori, all polling very well, arguably too well. Luxon has fallen below Hipkins as preferred Prime Minister. I mean, one of them doesn't have a lot of business experience, so the other ran Air New Zealand. And you do have to be a rocket scientist to run Air New Zealand. That's a very complicated business. And we may not like Luxon. He's not very charismatic, but he's safe hands, that's for sure. And the fact that he's polling above Hipkins is a worry. So make sure that you are aware that Labour tax policy will likely see the reintroduction of interest on deductions. They'll be seeking a wealth tax along with the Greens, and they'll bring in the crazy tenancy rules that we had that are being sorted out by national government. So I'm sure that most people on here are national voters or ACT voters, but make sure you remind people of this. This was very harmful to the property community, what Labour did with the Greens, and this is poison to us on top of what is a very difficult environment. And only next year we're going to be facing this. So we're seeing an increasing number of buyers through our client base. We know that because they start asking GRA to set up tax structures. We're seeing a lot more activity. Sure, we're seeing a lot of listings as well, but cost of ownership is now equal to cost of renting or below in some circumstances. So we're seeing, while the economy might be slow, we are seeing demand pick up for ownership of housing. Lots of job uncertainty. There's no expectations of strong capital growth in the market. No economist is calling that. And indeed, everybody's saying long-term growth rates are going to be closer to 5%. The thing that most concerns me is the soft tenant demand, which is linked to migration. And less migration, less people sharing houses. These two factors are really softening the tenant demand. It's taking a lot longer to rent a house now. We saw this trend late last year, starting to kick off. Rents have sort of capped at around 600 per week, and they're stuck there. Despite rates and everything going up, real yields are dropping because our operating expenses are going up. We're having to comply with healthy homes, and rents are capped, and that's an affordability issue. And with more property on the market, indeed, rents are actually softening, so it's not great. The properties are coming from accidental investors where you develop something to sell, and you decide to rent it out because you're not getting your price, or you've purchased another house in another area, you can't get your price, so rather than take the lower price of the market, rent it out and wait for better times. Newly built unsold homes being offered as rentals. These are the main drivers of the surplus stock around, together with all of the development stock that hasn't sold. So here's an accidental investor. They're trying to sell the house, and for 1.3, they can't get it. They're also listing it to rent as well. Very common in the market at the moment. So rents are capping out at $600 per week. Migration provides immediate and real demand. It impacts housing supply faster than anything else, and we've seen migration dipping negative in mid-2024. It's now trending positive. Tony said plus 26,000 to the year ending May. My figures for March were plus 33,000, so it's fallen since March. With supply exceeding migration demand in recent times, that's a wet blanket over the property market, and probably the biggest concern I have. Net monthly migration is certainly nowhere near 10-year average of around 36,000. Tony said 50,000. I have 36,000 as my number as the average annual migration. But you know, we're at the bottom end of it, so it's not good, and that's not good for housing. So we do have some new migrant policy coming through. Parents of existing migrants are allowed to stay for 10 years, and they've dropped the language requirement. That stops people leaving, so which is a positive. It does encourage parents to come in, which will stimulate demand. And also the $5 million investment visa category, again, the language requirements been dropped, and that's got to stimulate demand middle to top end. And you could see some demand for rental portfolios to tick that $5 million investment category as the money flows into investment properties. So that's positive. What we really need is working people moving to New Zealand to work here and live here long term. It's the best thing for the economy and the best thing for the housing market. I don't see that yet, and that's a sentiment thing. You know, New Zealand's just not a positive place to work, to migrate to. Apart from the beautiful environment, the wage conditions are lower than Australia, and there's quite a negative vibe here at the moment. So I can't really see the positive of migration yet that I'd like to see, but when we start to see migrants seeing New Zealand as a place that's equivalent to Australia, that will be a good thing. And I'll tell you when that might be. Australia has been pumping money with low interest rates and loose lending policy for the last couple of years. And I think there's going to be a crash in the Australian housing market because they're doing self-certified loans, you know, things that from the past during the GFC, we knew are terrible things to do in the economy, because eventually everyone lies about their income, borrows too much, inflation kicks in, they push rates up, those people don't have their incomes, they go out the back door. And I think that Australian housing market, which runs counter-cyclical to New Zealand's housing market, is going to crash, and that will be recessionary right through the Australian economy when that housing market comes down. So that might be the time when we start to look a bit shinier against Australia, hopefully. So Tony talked about densification and supply increasing. And what I like to do is graph migration, the blue line, against consents. And you can see migration has been far above consenting up until around about 2022, and migration's now fallen away. So the blue graph lines are household formation, which is migration divided by 2.8, which is the average number of people per household. So household formation, migration divided by 2.8, versus the orange line, which is building consent, shows you whether we have a shortage of housing or a surplus of housing. Ignoring COVID periods, traditionally we've been relatively short of housing, and now we're equal or oversupplied at a national level. When you break it down, it's actually a bit different. So here's Auckland. We're building too many houses in Auckland, and have done since the unitary plan kicked in. So we had all this pent-up demand where prior to 2017, 2018, you didn't have the unitary plan. So all the big backyards, you weren't able to develop them because our zoning was wrong. And then from 2017, 2018 onwards, we've had an explosion of townhouses in Auckland. CCC is the completion of the houses. You can see not all of the houses that get consented get built. But we're just making too many houses. And this graph really highlights it. So, and the second thing it highlights is consenting is falling off a cliff. And I think with consenting falling off a cliff, this is an aberration coming out of Adrian Orr, pumping too much money into the market, cheap and loose credit, followed by expensive and tight credit. Nobody wants to develop because there's an overhang of too much stock, and they can see that they've got stock up to their back teeth. All of the developers were donkey deep in their 2021 portfolios. So there's this big period where there won't be any development anytime soon because there's too many houses, and so consenting is stopping while the developers deal with what they've got. And that is very harmful. That's doing structural damage because people are leaving the economy to go to Australia. The surveyors, the engineers. I was talking to one guy this morning who said a local engineering firm in Auckland, I won't name them, had 51 full-time engineers. They're down to 29 and they're dropping to 25. So half, okay? So what do all those engineers do? I would put it to you that they're buggering off to Australia where they're paid more. And so when this does spin around and we need them, we won't have the productive capacity that we've developed in the last 10 years. So there's structural damage. It's not good. Another overhang of Adrian Orr. Development contributions, the government put these through the roof, local government, Auckland Council put these through the roof, and their proposed increases. You can see in and Northwest, they proposed 98,000, Mangere 29, Mount Roskill 52, Tamaki a whopping 119. So these are the development contributions for a new house in these areas. We were very upset about this as a practice, an accounting practice in property. I joined with Kirsty Merriman, a very smart property developer in Auckland, and together with other consultants, Simon O'Connor, town planner, and a bunch of other good people, we formed SANS, Subdivision Advocacy Group. We're basically a lobby group. We hired a King's Council, we hired Urban Economics, and we put no less than 17 official information requests into council. We found that their models were wrong. They're completely misleading central government and ratepayers, and they're breaching the Local Government Act. What they were doing was actually illegal, and our King's Council agreed with us that you can't mislead the public to get more money in than you actually need, and that's what they were doing. And the great news is they're back down, big back down. So if you look at Mangere, 27,000 versus 29, so that's only a small decrease. But so the far right column is what they were proposing, but Mount Roskill 33 versus 52 is what they were proposing, so that's 20 grand per house less. Tamaki 71 versus 119, still a big increase, but a lot less than the 119 they proposed. And in Norway, 72 versus 98. The other areas are all mid to high 20s. So big back down. They were really trying to ram these costs through the roof. And that's a lot of it's to do with what we did with SANS. We got their spreadsheets. They were inflating the costs over 40 years. They were not inflating the revenue. And that was 60% of the increase. So they were proposing 400% increases in development levies, and their model increased the costs over 30 to 40 years, but didn't increase the revenue. There was no inflation adjustment. So it was just completely misleading. They acknowledged it. They have written to us and said, yes, we should have inflation adjusted the revenue if we're inflation adjusting the costs. So here's for the developers in the group listening. Development contributions are applicable based on the date of the resource consent application date. So this is national things, but if Auckland Council or any other council tries to switch you to the DCs on the date that you get your resource consent, they're not allowed to do that. It's the resource consent at the date of application that you have to pay. And there can be a big difference in that, as my slides just highlighted. Here, so Auckland supply and demand, you can see we're making too many houses. That worries me about Auckland. But again, that's an average. Averages can be misleading. There's too many townhouses. There's not many or as many freestanding townhouses in the better areas being built in the top end areas. So there's still niches you can work, but terraced houses, we are awash with them at the moment. Whangarei, all over the place, but they've been making too many houses. You can see consenting is above household formation. Hamilton looks good. They are short of supply in Hamilton, and consenting is falling off a cliff. So I've hired some stats people to come in and peer review my data, because that looks too good to be true. If that is true, Hamilton's the place to be. That is fantastic, because they also have very good employment fundamentals, and so does Tauranga look great. So the consenting's falling off a cliff, and they're not making enough houses. So Hamilton, Tauranga, excellent places to be investing. Wellington, too many houses relative to household formation. People are not going there, and they're building too many houses. Christchurch looks crazy because they lost 10,000 houses, and then they're building 2,000 or 3,000 houses a year. But it's also the highest growth year from a highest growth area from an internal migration perspective. And the media say that, yet my data doesn't say that. So I'm getting that checked, because I get Stats New Zealand data. It says that they're building too many houses. So I'm wanting to verify that. So I've hired a stats house, Urban Economics, to have a look at that as well. Another thing to consider is incomes have been rising up until 2024. They've been rising quite rapidly, and and house prices have fallen 24%. So if you look at income as a multiple against a mixed median multiple of income and house prices are dropping, incomes are rising. And so the affordability of housing has got much better. The mixed median multiple of Auckland, for example, cracked over 14 in early 2022, and end of 2024, it ended up at below 10. So Auckland City is just above 10, and Auckland as an average is below 10. So that's a significant increase in affordability, and that trend is right across New Zealand, because the fall in house prices has occurred right across New Zealand. Income's up, house prices down. So that's a good thing that we're seeing. So the market is definitely stabilising. Consenting is dropping. That's a good thing, because we're making too many houses. And when we see more balanced supply and demand, and the overhang of the construction boom dissipating, that's when I'd expect to see growth back in the market. I think that echoes what Tony was saying as well. It's all about the supply. And what I'm seeing in the consenting and all those numbers is the consenting's falling away. So sure, supply is going to fall away, but demand is falling away as well as migration's dropped. So I reckon, and this is right on point with one of the questions earlier, with a double boom, you get a double bust. Investors lick their wounds. It takes time to recover sentiment. There's no fear of missing out in the market. There's plenty of houses. Credit's tighter. Lots of people leaving the country. Political uncertainty. There's global political instability, echoing everything Tony was just saying. I expect lower growth this decade. Better deals happen in this market. And okay, you make money out of properties three ways. One is capital growth, second is cash flow, the third is instant equity. So if you're getting lower capital growth, concentrate on income, concentrate on the money you make as you enter the investment. With our developments, despite the market being in rough times, we've got 30 houses on the go in Auckland this year. Our cost of construction has fallen considerably. We're building at 2.5 a metre, 2.4 a metre, locally at the moment, 2 level. And, that is just miles down on what we're paying over $3,000 a metre during the last boom, 2021. So we're building for less and we're buying the assets for less. So just because the market is tough doesn't mean you can't make money. And actually, we're making some fantastic margins. I'll show you in a minute. Because we're building for less and we're buying the assets up to $1 million cheaper for a development site in Auckland, fully consented. So, and this is right on point with one of those questions, which is why I asked Tony. The previous property cycles were 87, 97, 2007, 2017. Adrian Orr and Grant Robertson held hands, pumped the market up in 2021. Then we got a 24% bust. So did we bust hard enough that we'll see the next boom in 2027? I don't think so. I think that the next peak is going to be pushed out further out. Maybe it's reset to 10 years on 2021. So where we've had a 10-year cycle on the 87 year, maybe we'll see a 10-year cycle restart on the 2021 year, which would say next cycle peak could be 2031. I know that's just anecdotal, made up, but it wouldn't surprise me if you see the cycle has been broken by all that money that got pumped in 2021. Sure, we've had a bit of a bust, which has taken some of the heat out of it. It's not a bit of a bust, it's a massive bust. But with the new market conditions of much looser supply from densification, with all the councils getting on board with that, I just think it'll be more muted, and you could see that peak, that next peak pushed right out. So I wanted to give you a quick tax update, and nothing's really changed. So if you've listened to us before, you'll know that interest on deductions have been cancelled. You now get 100% deductibility for 1 April 2025. You'll know that the trust tax rate is now 39%, 33% for income less than $10,000. So everyone's using companies. Loss ring fencing still takes losses from residential property and prevents you from offsetting them against your personal income. And painting is back at 10 years, and not on the slide, but Brightline's now down to 2 years. So nothing's changed in the last 6 months. I won't dwell on that. In terms of what that means for choice of tax structure, LTCs are now less popular. They still get used in bespoke situations, but look through companies, LTCs. But these days, of course, companies become more popular because they have a 28% tax rate, which is less than a trust and less than an individual exposed to the upper marginal tax rates. Trust is still good for asset protection, so people try and put their assets in a trust for asset protection, but have the income at company level to get the 28% tax rate. And so you see a blend of ordinary companies and trusts being used for tax planning and efficiency. Here's an example of why you would use a company and a problem that comes from it. So let's just say you've got a trading company, whatever your trading business is, whether you're an architect or an engineer or an import-export company or a property trader, whatever it is you do, you're trading and you make $1 million. If it's taxed in the company, you'll have $280,000 of tax. And if you try and take that money out of the company, that is a loan to the trust because you haven't declared a dividend. And that loan of $720,000 attracts deemed interest from IRD. If you declare a dividend from the company to the trust, you have to pay the difference between the company tax paid, 28%, and the trust tax rate, 39%. So you pay the 11% difference. So you can't just take it out of the company and lend it to the trust. You have to pay tax on that as it's an interest-free loan to the trust, and IRD deem an interest rate, and it ends up with tax on the interest rate. So how can you use a blend of companies and trusts? In this case, we've got a property trader making $1 million in a rental company. What you can do is put all of your income at company level, loan the money into company, because the intercompany loan of $720,000 does not attract the 11% top-up tax. If you pay the income up to the trust and then loan it down to that company, you have to pay the 11% top-up tax to the 39% tax rate. But if you loan it into company, you don't have to pay that 11% top-up tax. There's no deemed interest because intercompany loans inside a wholly owned group do not attract a deemed interest on the intercompany loan. What that means is you're hanging on to 110 grand of the IRD's money. And so the compound interest effect of that, if you do that over a protracted period of time, you're making a lot of money. So, you're getting a tax deferral. You have to pay the tax eventually when you distribute it. But if you're paying down debt in your own investment company, you can take 110 grand and stick it off your rental debt. The following year, it's 220. The following year, it's 330. And with compound interest on that, that's a lot of money over 10 years. So this is a common structure that doesn't breach any IRD rules. It's government intent. It's just using the structures that are out there. It's very effective at the moment. A lot of people are doing that. That might help some people listening. If you'd like some help with your tax planning, this is such a complex area. you can book a free consultation on our website at gra.co.nz. Top right corner, just say request a tax meeting. That's for investors and out of Auckland. We deal with a lot of people out of Auckland and businesses. We have a lot of business clients as well as property clients. Now I want to rip through what I'm doing personally with my investments. I'm really quite spread at the moment. I'm building in Auckland, and I'm building to sell and building to hold. I'm building in Rotorua on our portfolio down there, and developing in mid Canterbury. Now I want to say the culture of this practice is we show you what we do so that you can copy what we do, so you can get what we get. And it makes us popular because a lot of accountants and a lot of property investors, it's secret squirrel. They hide it like it's some some secret, and their culture is that they don't want to share the intellectual property of what they're doing. But with investments, we see it as a commodity. We're not competing with each other. There's so much demand. I can only do so much in a year. We're not competitors. So our practice culture is we share what we're doing, copy what we do, get what we get. So I'll show you some of the stuff we're doing. This is Auckland. We've completed this last year. So we built this during the recession. Piece of land, 4 terraced houses. We bought the land and did the subdivision for 1.5. Construction cost 1.5. Total cost 3 million. Market value 4.6 to 4.8. Equity gain of 1.6 to 1.8. Now we've rented that to social housing. Beautiful houses to give to social housing, but they give full indemnity for the damage the tenants do. They manage the properties, so we don't have an 8% management fee that many people carry. So free property management and indemnity for damage. Our repairs and maintenance is actually lower with social housing, and 100% occupancy because they take 5-year leases off us. So this equity gain becomes developed to hold, no tax, no GST, no real estate fees. The cash yield's very good on that investment. And we have lower OPEX because it's developed to hold. Rinse and repeat. We've got 8 units on 38 Sylvan Road. We're just developing this right now if you're in Tier 2 South. Roughly our numbers, market value is 5.7, cost is 3.4. Reason we're getting such good margin on this is we bought the land with the subdivision consented, RC and BC, building consent plans. So that's 300 grand. And if you bought that in 2021, it would have been 2.35. I don't love the design, to be honest, but it's functional. So we've saved $1 million on the land. On the development side, we're paying 2,425 a metre, including GST, and that's excluding subdivision costs. But 2,400 a metre, 2,450 a metre is our build cost. Is at least $600-700 a metre less than during the boom. So we're saving a significant amount on the build, and we're buying it really well. You put these two things together, you can make money in Auckland in this market, significant money. We've done exactly that on 68 Wallfield Road, 4-bedroom townhouses. We've actually completed them. They're rented out into social housing, rinse and repeat. So this stuff you guys can copy. Go and pick up developments at big discounts that are consented and enjoy the lower build rates at the moment. It's working really well, despite the market being down. I also do land subdivisions, and that's our Darfield Estates subdivision stage 1, which we completed in 2023, 81 sections. That's on the right there. We took a bit of rural land that we bought, it was already zoned, and whacked in the subdivision. And that green block is that block that we did in 2023. I've bought the 37 hectares across the road, and we're just consenting 463 sections, and we're doing them over 8 to 10 stages. So that's that block of land there in Darfield. And everyone says, "Oh, you can't make money, it's a terrible time." We're doing well here. So it's not true. Stay positive. Go looking for the deals. So we've got stage 1 going here. We've got land from 257,000 a section, and that's affordable housing. There's a lot of demand for affordable housing in rural areas, and Canterbury's highest population growth area in the country at the moment. So we're targeting an affordable housing market, and it may be that a lot of developers, particularly in Rolleston, are finding it tough because they're unaffordable. Yet right next to Rolleston, we've got affordable sections which crack for affordable housing, and there's a lot of demand. This development, we've picked it carefully. It's close to Rolleston and Christchurch, and it's in an area with high growth for people. So Dartford Estates, have a look at our web, dartfordestates.co.nz. Affordability is the key to this investment. And Rotorua, same deal. We've been buying assets like this, and as I said, we've been stacking them up. We've got 25 1,000 metre sites out of our portfolio of 40 down there. This is Celeste Chand, a partner at GRA, and myself. Rough numbers, you build 2 houses, 700 grand each is the end values conservatively. Original house renovated is 475. So roughly 1.85 is the end value. The cost of it is the land, the reno, the 2 houses, and we're building at 2.3 a metre down there. Well, we've got offers to build at 2.3 a metre. Subdivision and consenting 1.3, it makes 29%, 532,000. Now, what I'm doing, which is interesting, is we're starting a China build business. So we're pulling these houses out of China at $1,800 a metre, constructed in New Zealand. And ignore the colour schemes. I'm not happy with the colour schemes, and that's a horrible car. But these are really good full layouts, New Zealand designed, constructed in China, and semi-constructed in China and imported into New Zealand. And so that's a business I'm involved in. And, you know, the metre rate's getting down to 1,800. It's a 180 metre house. So that's a strategy we're going to be teaching in our property school. And it's something that we're proving in our own portfolios, because the first 4 houses are in construction in the next 3 months. They're landing and going into construction. And it's taking advantage of the new MB rules that allow building materials with accreditation into Australia, CE marks, which is some of the European markets, in UK and Canada. If they've got accreditation up there for the building materials, we can import them here, and they are automatically compliant under our rules. So that is an excellent opportunity, and we're taking advantage of that. We're getting our meter rates right down. I'm using that for these two blocks, which comprise 29 units. They are being actually, we're not going to do them in brick, but they're going to be procured out of China, and we've got the pricing on those. So these new MB rules, which our modular homes business is going to take advantage of, allow area materials to be cross-credited, and the houses become fully compliant under New Zealand processes. So everybody says to us, oh, lots of people have tried this and failed. Tell you what they do wrong. They try and completely build them in China. Labour rates are $10 to $15 an hour in China. In New Zealand, $70 to $95 for qualified labour. Well, the key is you don't completely build them in China. You partially build them. Then you can go through a New Zealand building inspection process. So you're not extracting the maximum amount of value out of China, but you're extracting a significant amount of value by bringing them in semi-constructed in container houses. Most people are doing 70-metre houses. We're doing full houses using materials that you would see in New Zealand. So they look like New Zealand houses, designed in New Zealand and using New Zealand materials. We're getting the rates down to 1,800 a metre. So we're going to be offering these by year end. If you're interested in this, you can email me, mg@gra.co.nz, because that's going to be a significant advantage. They meet New Zealand building code. They're all large format houses, around 180 metres, and well under two grand a metre completed. So email me if you're interested in that, and we're going to be teaching this strategy in our property course that we run. So last topic is the property course, which is gra.co.nz. In this property course, which we've been running for years, we teach all the strategies which we're using in our portfolios as partners at GRA. so many properties you get into are dud properties. The mistakes are avoidable if you're given the right information to do your feasibility on and due diligence on, so you can avoid making mistakes that a lot of unsophisticated investors make. And the best thing about this course is firstly, it's cheap as chips. It's $500 roughly for a 7-week course, but it's a Zoom course, and we're doing a live online school, which we haven't done for 4 years, on August the 6th. So that's a change, because this has been an online course that you can just watch on demand, but we're doing an update of it August the 6th, which means if you're in that intake, you'll be able to interact with us live on the course and talk to us one-to-one. So you can scan the QR code, but this will be an excellent opportunity to learn about this China investing, which is something that the market hasn't seen. It's new. And from my own portfolio's perspective, I'm very excited about it. We're making good money out of it. So it's an online on-demand course. If you sign up now, you can actually watch the course in advance, or you can wait until August the 6th to do the live course with us. And because we're refilming it, and it's down to $495. So you get a free initial meeting with that with GRA. Take advantage of that course. Kicks off on 6th of August, and just scan the QR code, and you'll be able to enroll. If you watch this video after August the 6th, then you'll be able to watch the course that we did live on demand. That's all I've got for you tonight. Thanks for listening. Thanks to you, Tony, Alexander. I'm sorry, I'm not going to answer any questions because I'm out of time. I've got to go to another meeting with some Indians. But thank you all very much, and I'll close there. Good night.